Hello, everyone. Welcome to this PwC Tax Bite podcast. Today, we will talk about a new development, fresh development, a commission proposal to tackle the debt equity bias in taxation. My name is Pieter de Ree, and I'm very happy that I can welcome in my still virtual recording studio Jean-Philippe van West, a senior legal counsel in our team who closely monitors all European developments, and David Ledure, Belgian partner, but also leading the financial transactions transfer pricing network of PwC. So welcome, David, and welcome, Jean-Philippe. An important proposal again, and upon initiative of the European Commission, a proposal to tackle the debt equity bias in taxation. What I want to explore with you today is a little bit what we can expect, what is on the table, what we can expect in terms of impact, and which are the typical companies that would be impacted by this proposal. So to start with the first one, Jean-Philippe, can you elaborate a bit? What does this directive try to solve, and why is it on the table today?
Yes, of course, people. Yes, of course, Peter. Happy to provide an overview here and some background on the directive or the proposal. So, as we all know, when investments are financed, we need money, and there you can have two options: either debt financing or equity financing. And if we look at the tax treatment, interests are tax deductible. However, equity financing, so the dividend distributions, are not tax deductible. So from a tax perspective, debt financing is favored. And it is especially this point that the Commission seeks to address with its proposal, and it wants to make equity financing more interesting. This proposal, it's not totally unexpected. It was already announced about a year ago when the European Commission announced or published its communication of the communication on European on business taxation for the 21st century. And its communication, it said it will come up with a proposal in Q1, so the first quarter of 2022. So we're now the second quarter, so actually the proposal was already a bit overdue. If we look at one of the underlying principles of the proposals is that the Commission is of the opinion that companies with more equity that they're supposed to be more resilient to shocks such as the recent COVID crisis, and companies with more equity will have less insolvency issues. So that's why it's want to promote equity financing. And how does it seeks to do this? Well, the proposal contains actually two concrete measures. On the one hand, it wants to promote equity finance via the introduction as an allowance for additional equity. So a kind of notional interest deduction mechanism that we already know in some European countries. On the one hand. On the other hand, it wants as well make excessive debt financing less attractive and introduce a new interest deduction limitation rule. So, and with these two measures, it wants to reduce the bias towards debt financing.
Okay, yeah, thanks, Jean-Philippe. Now, first question that I have, and that I guess many of the audience will have, is, yeah, to who does this apply? Because we have seen some directives in the past applying for large multinationals. Other directives apply for everyone. So does it cover all companies or only large multinationals, this one?
Important. So this proposal has a very large scope, and it covers all entities subject to corporate income tax in one of the European member states, as well permanent establishments of entities not established in the EU. However, there is only financial undertakings, they are excluded. And if we look at the timing, so if you look at the proposal, it says that EU member states should adopt this proposal by the 31st December 2023, having effect in 2024. However, important is that it provides for a grandfathering clause for those countries that already have a kind of notional deduction system in place currently. And there's some European countries already have, such as Belgium, Portugal, but as well Cyprus and Malta and Italy, that already have a notional interest deduction in place. So for those, this grandfathering clause can be very important.
Yeah, thanks for that. Let's dive a little bit deeper in the mechanics now. David, can you elaborate us a bit on that one?
Yeah, so Jean-Philippe referred to two elements. It's making equity more attractive and from a tax point of view and ensure that debt financing is not too attractive. So on the first element, making equity more attractive, there will be a deemed deduction on equity. So you will see there are some similarities with our previous Belgian notional interest deduction, but also some very important differences. And if you look to the formula, there's a basis, an allowance base that is then multiplied by this notional interest rate. If you first focus on the allowance base, so the basis for the deduction, this covers net increases in equity. So you look on the year-by-year basis how much your equity increased, and that's in principle the basis for your deduction. Now it's a net equity in the sense that you will have to make corrections for your participations, like similar adjustment that we had in the past for notional interest deduction. Now, a net increase in equity that obviously has only a temporary impact. Now, the good news is that if you make an increase in your equity, you will have the deduction for that increase for the subsequent 10 years. So there's a long-standing impact of your equity increase, but of course it's limited. It's not based on your full equity, but also only on the net increase over the 10 years. If afterwards your equity decreases again, there is a kind of recapture mechanism to avoid that you will benefit too much. So you will have to pay back the initial deduction. But luckily, there are two exceptions. That is, the net decrease should or can be disregarded. One is if the decrease of equity is linked to losses, so operational losses and the like. Or secondly, if you can demonstrate that it was something that was imposed for regulatory reasons. So that's the basis. So the basis, net equity increase. If you then look to the rate to be applied on that basis, it's a risk-free rate plus a margin of 1%. To be complete, 1.5 for small and medium-sized enterprises, but for the other ones, it's 1%. This risk-free rate, it's a published rate that is updated on year-by-year basis, and that is then in function of the specific currency. But each year there will be a different risk-free rate. And then the 1%, why 1%? It was deemed by the Commission to reflect a credit spread that you would also have on third-party financing. So once again, to combat that debt equity bias, they indicated that there should be a credit spread, but it's a one-size-fits-all, the same for everyone. So if you then have your base and your notional interest rates, you know the amount you can deduct from your taxable basis. Now there's one limitation, and that limitation also refers to 30% EBITDA. So a percentage and a notion that you already know from the ATAT, the first ATAT implementation. So also here, your deduction for equity is limited to 30% EBITDA. Now, my reading, it's on top of the 30% EBITDA that you also use for your interest limitation. And finally, there's some carry forward rules. If you cannot deduct your full equity allowance due to the EBITDA limitation, you can carry forward the difference for 5 years. If you cannot use your limitation not to EBITDA simply because your taxable base is not high enough, that can be also carried forward, but there is no time limitation. So that's a bit in a nutshell the rules of the allowance on equity.
Okay, thanks, David. So base is multiplied by an interest rate. Okay, interest rate is probably what it is, depending on the market, but basis, there I would think, if I would be the commission, that's possible for manipulation by companies. So Jean-Philippe, I'm just curious, what does the commission include in the directive to avoid abuse or specific structuring to manipulate, let's say, the base?
Well, in the proposal, there's a specific article containing several anti-abuse measures, and of course, the Commission is afraid that, especially after the base erosion and profit shifting project and the introduction of 8.1, 8.2 in Europe, that this new notional interest deduction that they want to introduce in the EU, that it will be used for base erosion purposes, artificial use, or aggressive tax planning. So that's why they included some targeted anti-abuse rules, saying that certain increases in equity resulting from specific transactions will not be taken into account to calculate the equity allowance. For example, an example would be if you would have loans between associated enterprises, and this loan is between the associated enterprises are then used to increase the equity of another associate enterprise. Well, that increase in equity will be disregarded. Similar for certain contributions in kind. If you overvalue the contribution in kind, there as well, this the amount that is excessive amount will not be taken into account. As well for certain M&A transactions, there are certain as well anti-abuse measures. What is, however, important, and the Commission is aware that they cannot address all anti-abuse or all tax planning practices, and so in the preamble to the proposal, they make a reference to the ATAT, to the GAR in the ATAT, and that as well, that in case that even if the specific anti-abuse provisions included in the proposal do not apply, well, then still this ATAT GAR can still apply to certain transactions.
Okay, thanks, Jean-Philippe. So we've talked about the first measure now, the notional deduction on equity, but there is a very important second rule as well, I think, David, the one on the interest deduction limitation. What does that rule say?
Yeah, that's the flip side of the coin. So if you take a step back, the Commission want to promote the investments in equity, but they also want to disfavor, to a certain extent, luckily, the investments in debt. So to make that less attractive from a tax point of view. And that's one reason why we have the second measure. Now, the second reason is to limit the budgetary impact of the equity allowance. Now, what is a new rule? The new rule also refers to the exceeding borrowing costs. Once again, a notion that you may know from ATAT. So basically, it's all interest cost and financing related cost minus all interest income and related income. So once again, it's kind of the net financing cost that is a starting point. And in the new rule, 15% will not be tax deductible. So 15% of your exceeding borrowing cost is not tax deductible, and that's definitive. So there's no carry forward whatsoever. Not longer tax deductible as from the moment the directive come into play. Now we already have 8.1, so there's already an interaction with that one. Now it's both rules, one on top of the other. That means technically that you first apply your 15% limitation, and on the remaining 85%, it's normally tax deductible, but on the remaining 85%, you will then apply the 30% EBITDA limitation. Now, if you cannot deduct some part of the interest based on the 30% EBITDA limitation, that specific part can still be carried forward under the ATAT rules. So that's, in a nutshell, like the second but very important part of the directive.
Yeah, I see two sides of the same coin in a way. And you mentioned already the link to ATAT, David, but Jean-Philippe, do you see any other links with ongoing European developments, perhaps?
Yes, there are definitely multiple links. And first, there is an explicit link. So if you, together with the proposal, a Q&A was published, and as well some further guidance to the proposal. And there's a clear link with the European Green Deal. And so Europe wants to be the first climate neutral continent, and for achieving that, big investments, so big investments are needed. And to finance this green transition, it wants to promote equity financing and risk financing with this proposal. So part of the transition towards this Green Deal should then be come from equity financing, and this proposal should help this finding the necessary money. So that's a direct link. But there, of course, there are as well several other links with EU directives. For example, a first one, you can make the link between this one and the pillar 2, the introduction of the worldwide minimum tax. Because of course, if you introduce a notional interest deduction regime, you're going to create differences between tax accounting and your financial accounts. And of course, these differences can have an impact on your effective tax rate, and are therefore important to take into account. And it can even go that far that as a result of a notional interest deduction, that you can fall within the scope of this famous Article 4.1.5 of the OECD model rules, or Article 20, fifth paragraph of the EU draft directive, where top-up tax might be due even in a case where you're loss making. So there's a potential conflict between the purpose of, on the one hand, this directive and the introduction of a minimum tax. Next to the introduction of the minimum tax and the Pillar 2 draft directive, we have as well, there's a potential link with hybrid mismatch rules. Because as a result of a notional interest deduction mechanism, you create a deduction without inclusion. So there as well, it should be tested if this mechanism could fall under the scope of the hybrid mismatch rules of certain countries. So definitely important links with other tax measures that we know.
Okay, thanks, Jean-Philippe. And I think we are moving towards the end of the podcast already. So perhaps, David, may I ask you? You read the proposal a few times. What would be your key messages for the audience?
Yep. First one, I think it's good news that equity has also a tax deduction, so to combat that bias. Now, the objective is, in my opinion, not fully met because it's on incremental equity, not on the total equity. So there, the initial objective is only partially met and not fully met. Now, the good news is that increase counts for 10 years. Second element is the rate. So this risk-free rate plus 1.5%. Now, central banks are increasing the reference rate, various reference rates. So I think it's generally accepted that interest rates will go up, which, in my opinion, will highly impact those risk-free rates. So the deduction on equity should very likely also go up in the next coming years. Now, obviously, also debt funding will become more expensive in parallel. And the final important element is obviously groups should simulate the effects, but this is not just a discussion within the tax department. This should be a broader discussion because groups may need to reassess what their optimal funding mix is, because the costs of equity and the cost of financial debt will change, which might also be important information for the Treasury Department.
Okay, thank you very much, David, for formulating your key messages here. And I think that brings us to the end of the podcast series. So before we close, I have one last question for each of you. We have seen an unprecedented number of proposals the last months and years, more and more also upon the initiative of the European Commission. What's your personal view on this? Is this a good proposal? Does it come at the right time? Or should we, like some member states are voicing, take a bit of more time to measure the impact of the different proposals before initiating even further rules in Europe? I don't know, Jean-Philippe or David, who wants to go first?
Yeah, maybe I will kick off. As you rightfully said, the impact of all this is pretty uncertain, both I think for corporates, but also for countries. So I think in the next coming months, quite some simulations will have to be made. What's the actual impact of the two measures? Because there will be losers and winners. This directive was announced, but on the contents, the Commission was extremely discreet. So for many of us, it's a surprise what actually has been decided. So if this needs to be implemented by the end of next year and with effect from the 1st of January 2024, quite a lot of work has to be done. So for me, I'm curious how the various member states will react on this and whether will there be a broad support or not, because we will need to have unanimity if we want to implement this directive.
And maybe if I can add to that on the same note, but I'm a bit looking at the broader perspective. I'm a bit worried at the speed on which we see now proposals coming up. So we have, on the one hand, the introduction of this worldwide minimum tax, the EU draft directive to be implemented. We have the ETA 3 proposal. We have now this proposal. I think if you have a closer look at these proposals, they're not, let's say, not drafted in a perfect way. So I think that's something to have a look at and see as well. It's better to go a bit slower and have clear legislation that that provides legal certainty and not always go too fast.
Well, and with that, thank you, Jean-Philippe and David, for joining me, and thank you for the audience to stay tuned with us in this podcast series. If you want to receive the latest updates, just register on Spotify or Google with us, and I hope to see you or hear you again in the next podcast. Thank you.